Hello, 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 and happy Friday, March 6th. Welcome back to yet another live event where we unpack passive investing, multifamily, underwriting, one live event at a time. So, when non recourse debt still carries real risk, is the topic I want to cover today. But before we jump in, for those who may be tuning in or meeting me virtually for the first time, my name is Bessie Kapulian, a former commercial lender turned investor, entrepreneur, board advisor. Today, I focus my time on working with family offices and their family enterprises at the board level. I also work with private investors who look to diversify their portfolios by connecting them to well vetted cash flowing apartment passive investments. And last but not least, I coach investors new to multifamily on how to underwrite apartment deals from beginning to end from a lender's angle so they can protect their capital and invest with confidence. And for those who may be short on time, I also perform deal review, deal underwriting review, deal structure review, basically being the second set of eyes to give you that unbiased third party view so you can make an informed investment decision before you wire a single dollar into the investment. Without further ado, I came across an article by Globe Street regarding non-recourse debt. And by the way, if you'd like the link, I will share that with you. It's called When Non-Recourse is Not Risk-Free. But it resonated with me for a number of reasons. One, it's a topic that I have discussed before. But two, really glad that finally this topic is getting some public exposure because, as we all know, the devil's in the details, and it's important to know those before you walk in the deal. So, taking a step back, what is recourse versus non recourse debt? That's terminology you will hear frequently in the commercial real estate space and multifamily being part of it. Effectively, what that means is under a recourse type of structure, the key principal or key borrowing entity is providing a guarantee for the debt exposure. How that guarantee is structured could be a topic for another live event, actually, because there are different types of guarantees and different structures within those guarantee provisions. The opposite of that would be non-recourse, which effectively means is that if God forbid, the investment doesn't perform as intended, and the lender has to take over the property. Going after the collateral, in this case, the property, is their primary recourse, right? They won't be able to go after the borrower and their personal assets, or so many people think. And I up this topic because oftentimes investors think, well, if it's non-recourse, my personal assets are free, and even if when I sign the loan, if God forbid I have to walk away, at least what I've built right up to this investment and or other businesses and assets that I have will be protected. And that may very well be the case if everything goes right. But what a lot of people don't realize is that often these loan agreements have the so called bad boy, bad girl carve outs. And if you as a borrower don't comply with them, that can actually very quickly trigger a recourse. So, what you thought may be a safe structure may not be as safe for you anymore. Specifically, the article talked about the exculpation clause that effectively allows the lender to pursue the borrower personally under certain circumstances and under certain circumstances And so, as long as you are staying outside of those carve outs, you're probably fine. But if you're not, and very often if you don't read the credit agreement, the loan agreement, you may miss those. Um, Also, sometimes those carve outs may be written in a legalese that is intentionally broad, which gives the lender more levers to go after. Sometimes those clauses or actions may be limited to what people refer to as above the line versus below the line, which basically means that a violation of the above the line clause will hold the borrower liable only for the lender's actual loss, whereas below the line violation can result in full recourse of the loan amount. And so it's important how, what do you do about that, right? Is the next question. If that's the case, Vessi, what do I do about that? Well, first of all, uh, read very carefully, right, what you're signing, and read the credit agreement, and really understand what those provisions are, what they entail. Um, for the most part, right, real estate attorneys are not, real estate investors are not attorneys, so it does pay um, to engage counsel who's equipped with that knowledge and ability to read and understand and guide you through those agreements. So I'll definitely recommend that. And once you understand what they are, and take a step back and figure out, am I comfortable with the risk and how do I mitigate the risk? Very often I see investors who have the liquidity and net worth requirement to be invited into deals as sign as a key principal, which is effectively what they mean is that they're signing on the loan, because one of the lender requirements is for the borrower to have that experience, net worth, and liquidity to satisfy the loan requirements. And often they think because it's non-recourse, apart from, God forbid, the property getting foreclosed on, nothing adverse could happen to them. And that's not necessarily the case. So, what can you do about it other than reading the loan agreement is really not only understand the investment, but be in a position where, if the operator, for example, doesn't perform as expected due to gross negligence or other circumstances, you have ability to step in and take over operations. And what that means is that then you really need to know not only what you're understanding in, but how to operate a property. Ideally, if you are the key principal, you will be part of the uh, general partner or GP team. You will be very well versed in operating and investing in apartment properties, or frankly, that applies to any other asset class for that matter, and really have ability to control the deal. Because ultimately, right, as a key principal, you're putting your trust in the operator, and barring any exogenous events that are outside of anyone's control, you're really counting on them to execute on the business plan. So you're putting in a lot of trust. So the best scenario would be if you are one of those operators signing on the loan. But if that's not the case, and you're brought in to supplement the credibility of the loan by virtue of being a KP and signing on it, then you really have to think about, okay, if something doesn't go right, do I have that know-how, experience, and ability? Because if not, then yes, you could be held personally liable. The bank may have very well have ability to go after your personal assets, and yes, such foreclosure will impact your personal credit history, personal credit score, and frankly, ability to do future commercial loans if you, God forbid, don't satisfy these requirements and end up on the blacklist, so to speak. So for operators, right, who are bringing in KPs, it's important to be fully transparent about those arrangements. Definitely, again, spend time reading the agreement, understanding the above the line, below the line clauses, the bad boy, bad girl carve outs that I mentioned in the beginning, and really answer, take a step back and answer this question. Is this something I'm comfortable with? Is this a risk that I can live with? Can I manage or mitigate the risk? And if the answer is no, then if you absolutely love the deal and if you absolutely love the operator, then invest as a passive investor, right? Invest as an LP, but don't sign your life away without truly understanding the risk, and even worse, understanding it, but still walking into a deal hoping that everything will go right, and blindly trusting the operator. So there's a lot more I can share on the topic, but I will pause here. In fact, I briefly discussed this in my recently published book, which became an Amazon bestseller, Mastering Multifamily Underwriting: 5 Steps to Confident, Risk Smart Apartment Investing. It is available on Amazon in print, digital, and audio format. So you can enjoy reading it in the way that suits you best. And it's one of the topics that I cover in the book, actually. And if you do have any questions, feel free to post them in the chat. But even better, next week on March 10th, I will be hosting an Ask Me Anything virtual event. I host these quarterly investor parties 4 times a year, so every quarter. And given I've been getting various requests and questions from investors, I figured I will go live again. So if you would like the registration link, you please message me. I will also include it in the comments below of this live event. Those who are not able to join live will receive the recording, hence why registration is required for that event. And that's it for today. Let me know if the topic was helpful and insightful and added value to you, even in a small way. Let me know your one key takeaway, and if it generated additional questions for you, definitely feel free to bring this up during the Ask Me Anything investor party next week, March 10th at 5 p.m. Pacific, or put them in the comments. And LinkedIn and YouTube is usually where I pop in live. So I look forward to resuming our weekly schedule now that my travel is settling down. And I look forward to seeing you next week again. Thursday or Friday is usually when I pop up. Until then, have a blessed weekend. Ciao.